Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sise, your tutor and your mentor. Today, we are going to cover IAS 40, which is investment property. We are going to look at the distinction between investment property and property, plant, and equipment. We are going to look at how we can account for investment property using the cost and the fair value model. And finally, we are going to look at the linkages between the investment property and the property, plant, and equipment as per IAS 16. So now, when we are talking about investment property, it means land or building held for rental or for capital acquisition or for both. So if we have a building or a land that the company is using to support the day-to-day operational activity and the normal course of business, then that particular land or building cannot be classified as investment property because it is used for the day-to-day operational activity. It is used on the normal course of the business. So in that regards, we are going to classify that particular land or building as property, plant, and equipment as per IAS 16. Also, we need to note that if we own a building that is rented by a subsidiary of the entity, in the situation where we have a parent and a subsidiary, a two separate legal entity, but because of the consolidation, then we need to treat them as a single entity. However, then the building will be classified as investment property in the individual entity financial statement. So this is what we are going to do. But when we are going to prepare the consolidated financial statement, we are going to include the land or building as per IAS 16 as property, plant, and equipment, not as investment property. But when we are going to prepare the individual entity account, the parent and the subsidiary, we are going to show it as investment property. Whilst in the consolidated financial statements of the group, then we are going to show it as per IAS 16, property, plant, and equipment. So we need to note this. And also, when we are going to do our consolidation, then we can look at it further. So now we are going to look at the measurements, how we need to calculate the figures for investment properties. So now we have the initial measurement. Investment property should be measured initially at cost. It is obviously clear. We need to include all directly related costs: the purchase cost, the installation cost, you know, the transportation cost. All these costs should be included as part of the cost of the asset. That's why we are going to use the initial measurement approach to account for the investment property. Thereafter, we are going to use a subsequent measurement. IES 40 then gives a choice for subsequent measurement between the following. For subsequent measurement, we have option. We can either use the cost model or we can use the fair value model. Under the cost model, the assets will be accounted for as per IAS 16 on normal grounds. We are going to use the carrying value of the assets. We calculate our annual depreciation. We have our net realizable value. We keep doing it year on year. And when we are talking about the fair value model, we have different approach we are going to use as per IAS 14. Then once the model is chosen, it must be used for all investment property. So now, if we are going to use the fair value model, we need to use it for all investment property. So now, let's look at the technical bit of the fair value model. Now, we need to know these three conditions under the fair value model. I'm not talking about the cost, I'm talking about the fair value model. If we deciding to use the fair value model, this is what we need to know. Firstly, the asset is revalued to fair value at each year end. On annual basis, we are going to revalue the assets to ensure it reflects their fair value. Also, the gain or loss is shown directly in the statement of profit or loss, not other comprehensive income. Then finally, no depreciation is charged on the asset. Now, let me just explain a little bit. By right, as a student, you should be thinking about why we should include the gain, especially the gain on the fair value measurement directly in the statement of profit or loss instead of other comprehensive income. When we looked at IAS 16, the revaluation gain, is not taken directly to the statement of profit or loss. It is taken to other comprehensive income and the revaluation reserve. So why are we going to, you know, include the gain as per IAS 40, the fair value gain, into the statement of profit or loss? What is the reason? When we look at the prudence concept as well, and the prudence concept clearly stated that we should not recognize the gain until it is realized. We should not recognize the gain until it is realized. And also, a loss should be recognized when it is possible, when we're sure that we are going to incur that particular cost. So we need to recognize the loss. So this is what exactly the prudence concept is saying. But now we have a fair value gain that we need to recognize directly to the statement of profit or loss. So we need to ask ourselves, you know, um, the fair value model as per IAS 40, whether it is in compliance with the prudence concept or it contravenes the prudence concept. So as a student, we should start thinking about how we need to create the link and how we need to understand this particular matter. Now, I'm going to give you just an example of the reason, but I'm not going to, deliberate more because on our live online session, we are going to cover the reason why why we are going to recognize the gain in the statement of profit or loss instead of other comprehensive income, which is very much important. Now, if we look at the definition of investment property, it is held for capital appreciation or for rental income. So now, when we are going to look at IFRS 14, the fair value measurement, it defines fair value as the amount that we are going to pay or receive to transfer an asset within a specific market condition at a specific date. So this is the definition of fair value. So it means fair value, the changes reflect within the fair value, is the actual, the real performance of the entity. Now, what I'm saying, the fair value, it gives the current updated value of the asset. So as a result of this, the gain should be recorded directly to the statement of profit or loss because the changes reflect the entity real performance and the future cash flow prospects. We need to know this as well. So this is one of the reasons why we are going to show the gain in the statement of profit or loss. The other reasons I'm going to discuss it when we are doing our live online session. Then also, no depreciation is charged on the asset. When we are going to use the fair value model, we are not going to depreciate the asset. We are not going to depreciate the building. We are not going to do any depreciation. That's why on annual basis, we are going to revalue the assets to know the current fair value, to know the current market value of the asset. So fair value is normally established by reference to the current price on an active market for the properties in the same location and condition. So because of this reason, this is why we are going to recognize the gain directly in the statement of profit or loss instead of the other comprehensive income. So this is exactly in line with the prudent concept, because the prudent concept did not only mention about the recognition of gain when it's realized, but when we are looking at the revised conceptual framework 2018, the prudence concept is defined as cautious are or in neutrality. So we need to, when we are going to look at the live online class, we are going to understand it better. So now, um, let's look at example one. Let's look at example one. So we copy example one and we paste it on the drawing board. So now this is example one, and then very good. So Tima, a manufacturing entity, purchases a property for $2 million on 1st January 20X1 for its investment potential for capital appreciation. The land element of the cost is believed to be $800,000, and the building element is expected to have a useful life of 50 years. At 31st December 2021, the end of the year, local property indices suggest that the fair value of the property has risen up to 2.2 million. So now the first requirement stated we need to to show how the property will be presented in the financial statement as at the 31st December 2021 under the cost model and under the fair value model. So let's look at the cost model. The principle about the cost model is simple. We need to account for it using the cost and the depreciation. So we look at the workings. Working one, we have the land element, which is 800, and the building will be 1.2 million. Now, the building, we are going to depreciate the building. The expected useful life of the building is 50 years. So we are going to depreciate the building over 50 years. So we calculate our depreciation, which is $1.2 million divided by 50 times 1. You only need a year depreciation. So let me use my calculator, and then 1.2 million, $1.2 million divided by 50. So on annual basis, our depreciation will be depreciation will be equals to 24,000 dollars. So therefore, the value of the asset at the end of December 20x1, the carrying value at 31st 12 month 20x1 equals to the value of the building minus the depreciation. So this will give us 1.2 minus 24,000 will give us 1,176,000. So now, using the cost model, the value that will be shown in the statement of financial position will be for land, for land equals to 800,000, and building the building will equals to 1,176,000. So the total amount will be plus 800 will be 1,176,000. Then we are going to show the depreciation, which is 24,000. So using the cost model, this is what we are going to do. So now let's solve the same question using the fair value model. Let's understand the distinction between the cost model and the fair value model. Now, for the fair value model, we need to note the three conditions. One, on annual basis, we are going to revalue the assets to its fair value. Secondly, the gain or loss should be taken directly to the statement of profit and loss. Then finally, we should not calculate any depreciation on the investment property, which is very clear. So now, if we are going to solve this particular question, the fair value of the investment property as at the 31st of December 20x1 is 2.2, while the fair value of the assets as at the 1st January 20x1 is 2 million. So it's simple. We have a gain of 0.2 million using the fair value. So now let's solve this particular question so we can able to understand better. So we are talking about working two, the fair value, right? So we are looking at the value for land and building. So we say land and building, which is equals to $2 million. This value is at the 1st January X1, right? At 31st December X1, the value is 2,200, 2,200,000. So therefore, the difference is the gain, the fair value gain, which is 200. So now this fair value gain, we are going to show it directly under the statement of profit or loss. Simple. So fair value, fair value model, right? And then the land and building is equals to 2,200, right? While the gain on fair value is equals to 200. So this is how we are going to solve this particular question. So we don't need to calculate depreciation. On annual basis, we need to do evaluation. So you need to know the distinction between the cost model and the fair value model, which is very much important for us to understand. So now let's continue. Also, now we are going to look at the linkages between IAS 40 and IAS 16. Now, we are going to look at it in twofold. We are going to look at it from the fair value model, and we are going to look at it from the cost model. Now, what the linkages is about. Now, we are going to look at when we are using an asset in the normal course of the business, then we have been accounting for the asset as per IAS 16, which is the property, plant, and equipment. But now we have decided not to use the assets on the normal course of business anymore. So we want to rent the building or the land out, or we want to hold this particular asset for capital appreciation. So if this is the case, it means we have been, accounting for the, we have been accounted for the assets under the PPE, IAS 16, but now we want to move it to, to investment property. So what are we going to do? What are we going to do at the point of transition, and how are we going to account for this particular asset? So this is what we are going to cover under this section. So now under the fair value model, when asset is transferred from property, plant, and equipment to investment property. So now we are moving the asset from PPE as per IAS 16 to investment property. So what we need to do, it's very simple. Since we are moving the asset from property, plant, and equipment, then it means we need to, before we are going to transfer to investment property, at that point in time, at that specific point in time in which we are going to do the transfer, we need to ensure that we account for the assets as per IAS 16 before doing the transfer. So we need to account for the assets as per IAS 16 before we transfer the assets to investment property. So the assets must be first be revalued as per IAS 16, creating a revaluation surplus in equity as per IAS 16, and then transfer it into the investment property. So this is what we are going to do exactly. So now When asset is transferred from investment property to property, plant and equipment, from IAS 40 to IAS 16, what are we going to do? It's very simple. We need to, since we are using the fair value model, on annual basis, we need to do our evaluation. Gain or loss should be taken directly to statement of profit and loss, and no depreciation should be calculated. So what we need to do, we need to revalue the property first as per IAS 16. On that date, we need to revalue the property first. Then the gain or loss should be accounted for, should be taken to the statement of profit or loss, which is simple. Then therefore, we need to transfer the assets under IAS 16. Then we are going to start accounts for it under IAS 16, not IAS 40 anymore, under the fair value model. Now, let's look at the cost model. How are we going to account for the investment property under the cost model? Now, when asset is transferred from the property, plant and equipment to the investment property, IAS 16 to IAS 40, using the cost model, what we are going to do, the asset is transferred into the investment properties at the current carrying amount and continues to depreciate that particular asset. Because we are moving from IAS 16 under the cost model to IAS 14. So it's simple. We are going to ensure we keep maintaining the cost model. And as per IAS 14, when you are using the cost model, we need to depreciate that particular asset. Simple. Now, when an asset is transferred from investment property to property, plant and equipment as per IAS 16, what we need to know, what we need to have back of our mind. The asset is transferred into property, plant and equipment at the current carrying amount and continues to be depreciated. Nearly the same things we need to do. So we need to know how we can account for this. It's very, very, very much simple. Nothing, difficult about it. So let's proceed and see how best we can able to put this into practice. Now let's take a look at example two, right? Let's take a look at example two and try to solve example two. So we are going to look at example two. So example two, is reading the question. Okay. Example two. Med purchased an investment property some years ago and carries it under the fair value model. At 1st January 2021, the property had a fair value in Med financial statement of $12 million on 1st January. On the 1st July 2021, Med decided to move into the property and use it for its own business. At this date, the asset had a fair value of 14 million and a remaining useful life of 14 years. What amount should be recorded in MEN's financial and statement of profit or loss for the year ended 31st December 2021? So the question asks us about the amount that we need to record in MED statement of profit or loss. Let's look at the question and let's try to understand the question. So now, MED purchased an investment property some years ago and under the fair value model. At the 1st January 2021, the value of the property is 12 million. On 1st July, it means 6 months, that the ending of June, 30th of June. The property of the value, MED decided the property of the value is 12 million. Now, at 30th of June, MED decided to move into the property. It means we are moving from investment property to property, plant and equipment because we are going to use the property for the purpose of the business. So we can't account for it as at July. We can't account for it under investment property. So now let's understand the timing. From January 20x1 to the 30th of June 20x1, we are going to account for this property as investment property. So now what we need to do, we need to, to revalue the asset as at the 30th of June 20x1 so we can know the exact value and also the amount we are going to show in the statement of profit or loss as at the 30th of June 20x1. We need to know it. Then also, we need to know how we can account for that in property, plant and equipment from the 1st of July to the 31st of December 20x1. Then also, we need to calculate depreciation on the asset, 6 month depreciation from July to 31st December 20x1. So therefore, this is how we are going to solve this particular question. Now, at this date, which date? The 1st of July, the 30th of June, the asset had a fair value of 14 million and a remaining useful life of 14 years. Simple. Now let's solve the question. So let's look at the period first and let's look at the period. So we are talking about the investment property first. Investment property. Investment property. Ranging from the 1st January X1 to 30th June X1, right? So the value of the property, the fair value at 1st January X1 equals to 12 M, while the fair value at 30th 6 months June X1 equals to 14 M. So it means it means under the investment property gain of 2 million, and this gain we need to show it as an income in the statement of profit or loss. This is what we are going to do. So now we are going to transfer this particular property from investment property to property, plant and equipment. So when we are going to transfer it from investment property to property, plant and equipment, we are going to account for it as per IAS 16. we are going to account for it as per IAS 16. So now we are talking about PPE, which is IAS 16, right? The date of transfer is the first of 7 months, 20x1, to the 31st of 12 months, 20x1. Very simple. The value of the asset at first 7x1 equals to 14m. Very simple. Now, since we are going to transfer the asset from investment property to property, plant, and equipment, it means we are going to calculate depreciation as per IAS 16. We are going to calculate depreciation as per IAS 16. So now we calculate our depreciation. We calculate our depreciation. So depreciation for 6 months. The value of the asset is 14 million. The useful life of the asset is 14 years. The remaining, right? So we only need a 6 month depreciation, not a year. So it's very much simple. We divide it by 2, or whichever we want to do it. It's simple. Multiply it by 0.5. Let's make it simple. A 6 month depreciation. Let me use my calculator. And so 14 divided by 14 is 1. And multiply by 0.5 is 0.5. 0.5m. So the carrying value of the asset will be 13.5. So this will be the value at 31st 12 month x1. So it's very simple. So now the requirement stated that what amount should be recorded in merged statement of profit or loss. So now we are going to take only the items that are that are related to profit or loss. So now statement so now we are going to show the gain on the fair value, and also we are going to show the depreciation. So these are the two items we are going to show in the statement of profit and loss for this particular example. So now we can continue. So for investment property, this is all what we need to know about investment property. Very simple. You need to know the fair value, which is very much important. How we can account for investment property under the fair value model, and also at the point of transition from IAS 40 to IAS 16, or from IAS 16 to IAS 40 using fair value or cost model. What are we going to do? So these are the things you need to know. So let's take a look at these kit questions. I'm not going to solve in detail. I'm just going to give a tip because when we are going to do our live online, session for investment property, we are going to cover the solution in detail. So question one, which of the following properties owned by Scoop will be classified as investment property? Option A, a property that is held that has been leased to a tenant but which is no longer required as it is now been held for sale. Land purchased for investment potential. Planning permission has not been obtained from building construction of any kind. A new office building used as head office, purchased specifically in order to exploit its capital gain potential. A stately home used for executive training. So we are going to look at the answer when we are going to do our live online session. S co-purchased a new building with a 50-year life for 10 million on 1st January 2023. On 30th of June 2025, S co moved out of the building and rented it out to third party. So the building has been accounted for as PPE. Then as at the 30th of June 2025, the bill is no longer a PPE. We are going to account for it as investment property. And also, ESCO uses the fair value model for investment property. We are going to use the conditions on the fair value model. No depreciation, gain or loss should be taken to the statement of profit and loss. On an annual basis, we need to revalue the building to its fair value. As at 30th June 2025, fair value of the property was 11 million, and at 31st December 2025, it was 11.5 million. So this is the requirement. So basically, when we are going to do our live online session, we are going to solve all of these objectives and test questions. So this is all what you need to know about investment property. And stay tuned for the next session will be either IAS 38 or IAS 36. So thank you all. Welcome.